Good afternoon. Thanks for being here. We have this awesome responsibility today to handle the graveyard shift. Spare a thought for us. So my name is Rajesh, and I'm a partner with Deloitte. We are the infrastructure guys. And I've got to tell you something about people who work in infrastructure, investments, sales, purchases, capital raise, whatever. We are a very insular bunch of people. We believe that you're not part of the infrastructure clique unless you worked in this space for a long, long time since the inception of the space. And we think there's a moat around us. So that's just to get us started. So, in this sector, which I think, my view is that this space has advanced like crazy over the last 25, 27 years. It has progressed, the change in the segment has been enormous. So my first experience in the space was in 1998. Yes, remember the moat. In looking at perhaps the first appraisal for a toll road project in my career. In fact, I think Amar was representing the borrower. I was the lender, hereinafter referred to as God. And in those days, the most sophisticated issue that we could possibly think of, of figuring out whether our money was going to go south, was, those truckers on the road. Are they going to break down toll gates and break down barriers and bash up the toll attendants to avoid paying a 20 rupee toll? That was it. And we have come a long, long, long way because I mean, those sort of concerns have been left far behind. I'm from Delhi, so we still have people, breaking down toll gates and bashing up toll attendants, but it's not for a 20 rupee toll. Today, this sector has a lot of sophistication around it. I think that we are actually a very, very advanced financial market in infrastructure. We have a very deep project finance market. We have very interesting concepts like infrastructure investment trusts. So we have green bonds and all kinds of stuff. I work for clients, who come to me and say that they're astounded when they see, for example, in India, the framework for direct sale of green power to industries, because they say it is the most advanced framework that they've seen, anywhere in Asia. So that's the sort of backdrop that we have. And I want to actually start by asking Shri, who's also a person who I think is broadly as old as I am. In spite of all of this, here's my bet, Shri. If I were to go around this, on this stage and take a poll, and ask, where have you seen the bulk of your activity over the last 15 years, here's my guess. They'll probably tell us two things. 80% highways and power, and 80% central government interface, and not the states. And I have a terribly deep question for you. Why?
Yeah, thanks, Rajesh. Very difficult question. I'll try best to answer based on what I have seen in the industry. At the risk of sounding like I'm oversimplifying, I think there are two reasons, and third is a consequence. It is clarity, capacity, confidence. And this explains why the private investment is more concentrated, as you said, 80-20 federal state or 80-20 transport, renewables, transmission, and not in so many other sectors, despite the fact that the sector was opened up for reforms from the late 90s. We have a 24-year track record in the country. So what I mean by clarity is clarity in contractual frameworks, clarity in risk allocation, clarity in dispute resolution and settlement regulations. That is one big aspect. Second is capacity, where there are regulatory bodies or regulatory institutions that have been set up by a statute, or who are empowered, who have a credibility in themselves, and who have the capacity to absorb the complexities of contract, because PPP is ultimately a contract between private sector and the government sector. So where there is a capacity to comprehend and administer. And third is therefore, resulting from the first two is confidence. So wherever there has been greater clarity and greater capacity that has been built institutionally, we have seen more investments flow. So my answer to that is, this is the reason why the clarity has been, where the clarity was imparted. So it is roads, renewables, transmission. Bulk of the investments have gone in core infrastructure into these areas. Now the question is, why has it not happened in the other sectors? At least we have a partial answer that where it has happened, private sector has certainly seen a difference in the, seen it attractive to go in and achieve risk-adjusted, better risk-adjusted returns. So I hope I've answered the question.
No, thank you, Shri. And by the way, I should have mentioned that Shri is managing director at Edelweiss Infrastructure, has invested in and manages a bunch of investments in infra concessions, so he should know. Okay, so right across the stage. So Ami, who has also, I think, witnessed a lot of evolution of the sector, although my understanding is she's perhaps not as old as she and I. That's what I learned today. So Ami is a director with KKR. And Ami, tell me, over the last maybe 15 odd years or so, what do you see as the change from an investor's perspective in how you view the market? And honestly, what did you look for 15 years back? What do you look for today? Just useful to understand.
Sure. Thanks, Rajesh. If you look at the infrastructure market in the late 2000s, you had the PPP construct in place. You had a lot of assets that were under construction, but there were no scale platforms really. Everything was under construction. Investors were expected to underwrite development risk. And to be fair, I think everyone was learning. The EPC contractors were learning to be developers. They had not done that before. Regulators were learning to understand what's the best framework here. And investors were just investors. There was no bifurcation between private equity investors or infrastructure investors. India was perceived as a growth market, which it still is. But there was perhaps underappreciation of risk. I feel like over the last 10 years, investors are just more sophisticated in thinking. It's infrastructure as an asset class that has evolved globally, and that learning has been transferred to India as well. And investors know what is the risk they'd like to take versus the risks they would rather stay away from. So I think the market has significantly evolved. Even on the developer side, you see a new bunch of developers, you see better governance, you see better asset quality. So I do think just overall the markets come together, and there are plenty of operational assets that investors can invest into today as well.
So, and just to understand, Ami, you're reflecting the views of global LPs. You're talking about people around the world. Yeah?
Yeah, absolutely. And India is not a market you can ignore anymore. It probably runs the world's largest PPP programs. You have contracts that are tested, that have stood the test in courts as well. So I think overall the market is fairly conducive, and it's just a reflection of all of that coming together.
So Amar manages real assets is I guess what we call it at 361, and I find this very interesting because Amar, you actually play in a slightly different segment because you actually manage a lot of domestic money, which is interesting, and it's interesting to see that come into the country. I do want to talk about that come into the sector. I do want to talk about that, for a minute. But given the fact that we've had a ton of history in what I call the 40% of the market, which is on the highway space, right? What would your tips be for my stubborn trucker who 25 years back refused to pay a 20 rupee toll? How have you seen that trucker evolve over the last 25 years?
Absolutely. There's a sea change in the way the sector is viewed, not just by investors, but also by developers, by contractors and the regulators. 25 years back was the country's first BOT toll road financing where I was associated with that time. One of the issues you mentioned was the ability to pay the tolls and on a consistent basis, not just the truckers, but even the residents of the localities, even 50, 100 kilometers away would shy away from paying tolls. And all of that was also very, very prevalent. But apart from that, we have seen a sea change in the regime and the master concession agreements now. For example, the entire variable period concession agreement depending on the traffic and the returns, basically to give comfort to the users and to the concessionaires, didn't exist that time. Now it's very much prevalent, and it gives a lot of comfort. Second big area is the ability of lenders, for example, which wasn't there earlier, to to take over the asset and step into the shoes of the concessionaire and to run the toll for the remaining period, which also wasn't there. So lenders at that time effectively were lending unsecured because road is a road. You can't take it and replace it or change it somewhere. So that was effectively the kind of lending that happened in the late 90s and early 2000s. The other big change, sea change, is the entire ETC and FASTag, which didn't exist then. So if the toll was 25, 30 rupees, perhaps 20%, 25% would have gone into the O&M contractor or whatever, and the local people who would manage it, and that was a business by itself. There was, in fact, businesses which thrived based on O&M contracts and O&M managing of toll booths. So that business, thankfully, is out of business today. Apart from that, a lot of other changes in the way the entire financing and the ability of finance to be raised on long-term basis, both from offshore and onshore capital. The appreciation of inflation as a pass-through, which didn't exist again in the very early contracts, which now is a standard, which is WPI, 40% of that plus 3%. Now it's all given and set, but all this didn't exist. So point I'm trying to make is roads is perhaps the only sector which enjoys a lot of this, inflation pass-through, electronic tolling, diversity of the entire user base. And like Shri mentioned, which was very good, clarity, confidence, and the entire scale, that has given a lot of impetus to this sector. A lot more can be done, I'm sure, from here, but this sector has really taken off in a very big way. Nowhere did we think of this about 20, 25 years back, that we'll be sitting and talking such great things and such great developments that have taken place in the road sector.
There's actually one place where that trucker of mine has still won, which is on the Delhi-Noida, the TND, because those tolls were taken off. So Neha is an executive director with Morgan Stanley Infra Partners, and I have a theory. And I feel that I've been right for at least 2 decades. If you go through the conventional literature and all the announcements and all the stories, right? The headline story always is Indian infrastructure, trillions and gazillions of dollars, and the numbers start scrolling off the screen, and you think like, wow, to fund Indian infrastructure, basically, BlackRock would have to relocate to India, right? And here's the funny thing, in practice, I've never found that to be true. The actual bankable portion, addressable portion of the market for investors is a fraction of the trillions that you see scrolling off your screen, right? In fact, it's been my experience, you build an asset, the investors will come. It's actually been the other way around. Yeah, it's actually been the other way around. You build an asset that's bankable, the investors will come. So I feel that a lot of investors have actually been looking to reinvent themselves in what is actually a very crowded market with a lot of money sloshing around. Yeah, and Neha, would you like to talk about this, because I know that the way that you guys are looking at the sector is maybe a little different from the way we understand concession financing.
Yeah. Thanks, Rajesh. So. You rightly mentioned, I think infrastructure as a sector has seen a lot of investments, a lot of capital flowing in. But if you, as has already been mentioned by the panelists here, if you were to dissect those investments, it will largely be, or predominantly be in 2 or 3 sectors max. You have the roads, highways, renewables, power. That would probably constitute the bulk of investing, private investing in infrastructure. But an economy like India, there are many other segments of infrastructure that also need to scale and are actually quite vibrant in addition to roads, renewables, and power. So if we look at logistics, if we look at the massive waste infrastructure or the waste problem that needs to be solved for, or the other social infrastructure sectors, those also require similar amount of investment. But why have the former sectors of renewables and roads attracted so much capital? It's because of regulatory tailwinds, the concession structures, the monetization avenues have actually advanced in these sectors. But there is one aspect which maybe government or PPP concessions cannot really address, and that's the entrepreneurial activity which is happening in India at a very vibrant scale. And if I were to just sort of draw an analogy between infrastructure investing and private equity investing, in private equity investing we have funds across different segments, starting from seed to venture capital, to growth stage, to late stage private equity investors. And there is enough depth in each segment in classic private equity, whether that's tech investing, consumer investing, so on and so forth. I think that similar depth is at this stage probably still evolving in infrastructure investing. We have a lot of large funds, big pools of capital that are investing in the infrastructure space in India. And hence, a lot of investment is happening in segments where the risk has been addressed by the various concession changes, PPP agreements, or the intermediaries like SECI, etc., who've come in to reduce the risk. But there's still need for capital at the growth stage in sectors where these elements are not present. But there is still a lot of entrepreneurial activity happening. So I think that segment within infra needs to deepen. It's a segment that as a fund we've been targeting. The growth stage, the growth stage capital is what we're focusing on within infrastructure, and investing in sectors which are both in core as well as allied infra. And our philosophy has been to invest in these sectors at an inflection point and manufacture assets for larger funds to invest in.
And just out of curiosity, in this segment, with whom do you compete? It's more generalist investors? It's more early stage investors?
I would say growth stage investors, but not really who call themselves an infrastructure investors. It's a mix of both private equity investors, growth stage investors with whom we are so-called competing.
Okay. So there's a guy on stage who I realize, after spending the last couple of hours with him, is highly sought in this forum because I think one of the hats he wears is also as an LP, right? So Kishle is with the AIIB, and that's I think and I think your orientation will be maybe a little bit different from many of the people on this panel. I always felt that the multilaterals played a huge role in the sector when it was evolving. I mean, I know it's still evolving, but when it was really nascent. The first guys to invest in renewable energy platforms when they were hardly platforms, it was the multilaterals. The first guys to lend to transmission projects when nobody knew what a transmission TSA looked like, it was the multilaterals. I'm just curious though, in 2024, right? How do you see the relevance for yourself? And I do appreciate that many people are actually not that aware of the AIIB mandate in India and your presence. But it'd be really interesting to understand what's your perspective, and I'm going to put it very crudely. Why do companies come to you?
Do I need to reply that? Sure. So first of all, thanks IVCA, thanks Rajesh. Good to be here in Mumbai, and I think for a change, which is very perceptible, we are talking about opportunities and less on challenges, which is much ahead, forward-looking. So compliments to all of us in this room to have that ecosystem which is forward-looking. So yeah, you asked me, so let me introduce very briefly about AIIB. AIIB is a new multilateral institution with 109 sovereigns with a pooled capital of 100 billion to support sustainable infrastructure in emerging Asia. What we have done is we have made 50 billion commitments in 40 countries over last 8 years of since our inception. Why they come to us, I think I'll let Neha and Shyam talk about it because we were the anchor LP in there. So I think from AIB's vantage point as a multilateral institution, the most important thing is crowding in and mobilizing capital. So that's a given because if we are coming along, then that's a very big testimony of things because of our international standards, and likewise, which are policies, which I not talk much about it, which is a white elephant, which people say too much to talk about. But the most important thing is mobilizing capital from a multilateral institution where we come from. Second important thing is ESG. I think ESG has been on the periphery for long. I think ESG has come center stage, but has ESG institutionalized in investment decision? Has it gone down and become institutional? Are people seeing it as a business? So what we bring on the table is the global best practices and adapting it to the national requirements and making these institutions more sustainable. Because sustainable infrastructure, one thing is to create infrastructure and how do we make sustainable infrastructure. So that's the two important things which drive us. One last thing on India overall, I think from a investor which does LP allocation, does co-investment, is doing direct now. I think, and from a very comparative emerging market sense, we see three challenges, which I just want to lay out with all the good things and again in the forward-looking thing. One is the currency devaluation. I think the currency has remained strong for some time, but our macros are more stronger, again, in the forward-looking currency devaluation. Second is timing of exits. So generally, we are so much in investing mode that we are perpetually investing and not thinking about harvesting and exits. So from the cap which we wear as an investor, you have to invest, harvest, and exit. That perpetual exit mode is something which can't remain, and India has to still catch up on getting that. The point you are entering, a clear exit plan should be on the table. And the third is, it's good that India is getting deep in some markets, but the sustainable competitive advantage is also eroding. So how do we ensure that the market is either big enough that the sustainable competitive advantage remains for there? So I'll take a pause here, and I hope now you will come to or help get some investors to AIB.
Yeah, the jury's out on that. Okay, I'm going to run an experiment. Let's see if our audience is awake. We have 2 minutes to raise questions. Any hardy person who wishes to ask a question of this panel, not me, I'm just the subject matter expert, one of these guys. Please go ahead.
What regulatory change, not arbitrage, would you guys like to see to ensure that this country gets another 10x of what it got in the last couple of years in terms of capital that does the true significant and sustainable competitive advantage point that was made by the last speaker? Thank you.
Can I take it first?
Yeah.
Lots to be done, but I want to pick two. One, on a regulatory side, is to replicate what everybody here unanimously feels. Whatever PPP formats have succeeded so far in whatever sectors, that is energy, transmission, or roads, we don't need to reinvent the wheel, just replicate it in other sectors. We can replicate the similar formats in water, wastewater, or other areas. So there is no rocket science. Replicate, but replicate it with regulations and capacity building so that it can ultimately attract the investment. So that's one part on what can be done. And we don't need to think a lot, just replicate it. The second is exactly what Kishlaya mentioned and Neha also referred to, is exits. We need to have much greater force of the regulations and force of policy to speed up the recycling of capital. Because as long as we are all in an investing mode, everybody sees the large market in India in infrastructure, and the investing opportunity is unmistakable. I don't share Rajesh's pessimism. I'm actually an optimist that we are in the sector at an inflection point.
So am I.
So there is immense opportunity to invest we need to give so much more clarity and speed to recycling. I think Amar represents that pool of capital, which is, there is a strong domestic market, public provident fund market or domestic pension market, which is very, very forthcoming now to look at listed alternatives such as investment trusts or other such formats. So there is a very growing market which is positioned well to capitalize on the recycling opportunity. But the ease of exit approvals, the whole process of regulations and approvals where projects get entangled, claims, disputes, a lot of the assets just don't see the exit path. So we just need to focus, in my view, my two top picks will be replicate the success of the PPPs into other sectors. It is highly doable in my view. And second is significantly give the thrust and accelerate on exits. So that there is clarity, as Kishlaya mentioned, size of the opportunity, investing, asset management, exit.
Yeah. I'll just add to a bit on that, Kuldeep. So taking the successes of roads and renewables, yes, we have reached far more than what we had thought, but from here onwards for the next 10 years, and if you look at the NMP numbers, I think 26% of 6 lakh crores is to come from roads. But given that the way it's happening in the road sector or renewable sector, let's take roads for a moment, there needs to be clarity and a kind of a blueprint that's made available, at least for the next 3 years, as to which roads and what kind of privatization, whether it is BOT, TOT, HAM, EPC. So there needs to be some degree of predictability and clarity that needs to come out from the government, which would enable far better planning from both global and domestic investors to look at various options and various risk-taking mechanisms. Once that is there, can better and far bigger capital come into this sector, much more than what it is. And obviously, from an exit point of view, I completely agree with Sri that while there have been, if you look at InvITs today, 22, 23 InvITs, half of them I think are roads, but still in terms of whether there is enough and more liquidity in the InvITs, whether the regulations provide for that, whether they are just listed instruments without liquidity, and therefore is the yield compression and the price discovery actually happening as it's intended to be. These are questions that I'm sure investors, regulator, and the developer or the platform operator would at some point get the answers, but the sooner the better.
So you're saying market making in that last point?
Second point, yes. I'm sure it's happening, and I'll come to a bit on that as we go along.
Sure. Thank you.
Thank you, sir. Thank you, sir. You are certified. You're officially certified as being awake. A couple of things I just want to pick on, and maybe Amar, we can actually, since you're in flow, maybe we can come to you on that. This whole point about domestic sources of capital now being channelized into the equity side, not the debt side, the equity side of infrastructure concessions. Clearly, that's something that you guys are doing. Would really like to hear a little bit about how it has been so far.
Oh, absolutely. It's a amazing source of capital. Just started to tap that source. And let me just step back for a moment, not just for infrastructure or real assets, but if you look at the journey over the last 10 years, let's say 2012, 13, the domestic component of which is institutional, retail, mutual funds, all of that put together in the overall equity market in the country was about 25% of all the listed stocks. Today it's 36, 37%, 10 years. So that's the overall listed space in the country. If you look at AIFs, we heard this morning, Mr. Anant Narayan. So what he mentioned was that out of 4 lakh or 4.5 lakh crore which has been deployed, about 65% is domestic. All sectors AIFs. If we look at InvITs and REITs, which is coming to this sector, if you look at, and let's look at a division between private and public. So if you look at public InvITs and REITs, which are all public, about 65% or 66% of the capital is domestic. I'm talking about non-sponsor. Non-sponsor, 65% is domestic in the public InvITs and REITs, and 35% is offshore. In the privately listed ones, it's the reverse. Foreign capital is about 62%, and domestic is about 38%. So that's it shows a very clear trend that the entire domestic capital is making its presence felt more in the public listed, in the public traded InvITs and REITs, and gradually also increasing in the private InvITs. So for example, in the last few InvITs that we have seen in the market, and we regularly look at these InvITs from an investment point of view from our funds, about 25 to 30% of these InvITs have been subscribed to by wealth managers or UHNIs and family offices and so on. This number was much lower about 18 months back. So within these 18 months, we are seeing a sharp increase, possibly because this capital has become more discerning, more evolved, has also seen the experiences over the last 2 to 3 years or 2 to 5 years in the InvIT and REIT space, and is willing to take that kind of, willing to experiment with this kind of avenues of deployment, which are yield-based and with a definite upside based on inflation, and not linked to the equity multiples in the stock markets, because that's again a different space that they have an avenue to deploy into, but that obviously that is subject to those valuation multiples that exist in the market today. So this is kind of a diversification for them, kind of ability to deploy into areas that are needed, of course, by the country, and also into very good asset quality, run by very good sponsors like the best pension funds, the best global funds, the best Indian houses, and so on. So there is a lot of potential and a lot of money that's coming in, not just from domestic UHNIs and family offices, but also from domestic institutions, which are just warming up now, be it the pension funds, provident funds, and the life insurance companies. So there's a lot of capital that has come in, and a lot more that will come in the next 2 to 3 years based on the success that we have seen. Had this initial round not been as gratifying for the investors so far, possibly the sentiment may have been dampened. But given that the sponsor quality, the asset quality, and the instruments and the regulations around it have been pretty conducive and favorable, I expect this capital to only increase in the next 2 to 3 years, significantly more from today.
No, thanks, Amar. Sorry, Ami, Amar has tried to steal a lot of your thunder, but you are front and center of the Infrastructure Investments Trust story in India, right? Where do you see this going? And also, you know, I must tell you, by the way, I was very happy because I pointed out a fact that didn't strike Ami earlier today, which is that even in the InvIT story, if you look at the bulk of the ones that have happened, right, they happen to be in highways. Yeah. So interesting. So again, why, how, when?
Very interesting observation. I think the first differentiation is sector versus size. The largest InvIT in the country is actually not in roads. If you aggregate all the roads InvITs put together, they're still smaller than the fiber InvIT that happens to be in this country, right? So the way to think about it is in terms of assets under management, and fiber is probably 45 to 50%, roads is probably at 30-odd%, then you have transmission with 10%, and then you have renewables, warehousing, schools, etc., that sit in a very, very small basket. So there is just so much legacy to roads in India because it started first, very, very fragmented ownership, investor ownership. So every time you think of a developer or an investor monetizing, an InvIT is a perfect story. Can this be replicated with renewables? The answer is yes. I mean, there were arguments saying this is a decreasing EBITDA line in renewables because you have degradation each year. Is this InvITable or not? We've proven it is. There's another InvIT that recently was launched in renewables. But I think the other classic debate that happens with InvITs is yield versus growth. The question is, if someone's willing to pay you a multiple on the pipeline, is it better to basically keep it in a company structure and grow and enjoy that equity upside versus converting an asset into an yield story where you're just transferring assets to pull cash flow? So I think there is an answer which is different for different situations, different developers. So I think every situation that you'll see will be different. But If it's a long-term yielding instrument or contracted cash flow, there is a good case to be made that it is inevitable. But honestly, there is no barrier in terms of sector, et cetera, in our minds at least, when it comes to a product being inevitable.
Yeah, thank you. Kishne, I'm really sorry, but since you're a visitor to our shores, I'm really tempted to put you on the spot again, right? Climate,
Still not convinced.
climate, energy transition, sustainability.
The bell rings. As soon as you say climate, the bell rings.
Yeah. Okay. So, okay. Yeah. What does this mean? And tell us a little bit about how this actually benefits the companies that you invest in. Really keen to hear that.
Yeah. So I think on a serious note, while we are talking about infrastructure, I didn't heard the word sustainable infrastructure much. So I think the way forward is having a sustainable infrastructure, and climate story is a part of it. It's no more a story, as I say, it's a story. The point is, these climate risks are so embedded in the infrastructure asset class that first it has to be seen as a business risk, business continuity risk, and from there on it becomes a most institutional way of seeing climate mitigation, adaptation, or resilience. So from a multilateral institution, after the Paris Agreement in 2015, all the multilaterals agreed that from this last year onwards, all our investments will be Paris aligned. What basically means any infrastructure asset to be Paris aligned, that there is a clear path of climate mitigation, adaptation, and resilience built in the design of the asset until the exit of the asset. So, and this is something which can't be done in a piecemeal basis. This has to be very institutional, it has to be strategic, and there is a business risk element. And as a multilateral, our role is to go to our stakeholders and talk about this, that see it from this lens.
Thanks very much. So we're getting the nasty looks that suggest that we're out of time. So thank you so much. Thank you so much to the panel. Thank you, everybody. And I just have one last thing to say. Actually, contrary to what Sri believes, I actually am not pessimistic about the space in India. Because there's an interesting thing, and there's a lot of, I think, misunderstanding about where we stand actually on the global scale. Because if you actually talk to, there's this general impression that risk mitigation in India is difficult, our contracts don't measure up, stuff like that, right? That is not true. That is not true. If you take a typical concession agreement for a typical asset in India, it is actually world class. It has gone through 25 years of development. Risk sharing is extremely good right now. It's really more a question of implementation. And I do think that we'll see a lot more of that over the next 25 years. Thank you all.